Howdy, Jacob here. Today we're looking at Idexx Laboratories in the healthcare equipment and supplies industry. It looks like they develop, manufacture, and distribute products primarily for the companion animal veterinary, livestock, and poultry, as well as dairy and water testing markets. It's a huge company, 46.3 billion market cap on pretty much the same enterprise value. Growth is over double over the last 10 years, so great revenue growth. Margin growth is also great. 5% increase on gross margin, 13% increase on operating margin, with return on invested capital nearly doubling, being 36% in the most recent year. It looks like they have been repurchasing shares, so that does inflate your ROIC numbers. But the debt situation, they have 450 million cash on hand with 750 million in debt. That 750 million is less than their 1 year, most recent year free cash flow. So, from a balance sheet perspective, love it. Beautiful company. Use of cash is very heavy on share repurchases and then a little bit through reinvestments and acquisitions. So that's pretty cool. They're not paying a dividend. It looks like they're really trying to grow the business internally. Nothing wrong with that. That can be a great use of cash since everything is just what you do, or everything is just the return you get for the use of cash. So a dividend's not going to get you much more than 9-10%. So repurchasing shares that for a great company growing well beyond that can be a fantastic form of reinvestment, as well as actually reinvesting in yourself and getting hopefully those 30% rate of returns, which would be absolutely amazing for you as the investor. Let's start making some assumptions here. Healthcare equipment and supplies industry. I mean, I don't think that that's going down anytime soon. It looks like they're a humongous player here. So maybe let's do 8%. At the end of 7 years, what is it looking like? Probably 20 on the PE, price to free cash flow. I could easily see that. Margin side has been going up. Let's do 21, 23, just to have a little bit of range there. And then let's assume they buy back 0.5% of shares. We're saying that it needs to fall 78% to get to the return that I'm looking for. To me, that makes sense. It's currently at a 55 PE, and the growth isn't beyond my discount rate. And so you can buy a company at a 50 PE if it's growing 20-25% a year and you want a 15% return, because the contraction from PE can still make up for the fantastic rate of return it's getting. But I'm saying that 54 PE is just not even close to what I'm thinking for it. At the end of 7 years, I think that it's going to be a pretty mature company with, growth ahead of it, probably beyond inflation. But will they have a moat? Yes, again, probably. But to me, I'm very conservative with my P's, and so um, this the 78% fall that we're saying it needs to happen just makes sense for me, given how inflated their P is. So hopefully you enjoy the video and have a great rest of your day. Thank you.